Welcome to today's explainer. We're cutting right through the surface level macroeconomic noise to uncover the massive structural shifts anchoring the cryptocurrency market today, May 5th, 2026. You know, the headlines are obsessed with the day-to-day chaos, but beneath all of that, we are witnessing an absolute fundamental rewiring of digital assets. We've got a lot of ground to cover, from private equity tokenization to some pretty existential cryptographic threats. So let's just jump right in.
$85,000. Let's just start with this massive number, because despite Bitcoin recently cracking a really tough 7-month ceiling, this much higher target is suddenly very much in play. And actually, it might sound like a massive leap, but this isn't based on some wild market euphoria. It's grounded in the actual mechanics of a brewing forced unwind that is staring the market right in the face.
What's totally wild here is the severe divergence we're seeing on the institutional side. On one hand, we have this clear rising price action with Bitcoin pushing higher. But at the exact same time, professional funding rates, which are basically the fees traders pay to keep their leverage bets open, are inexplicably stuck in the mud at 2023 lows. But tells us that a huge chunk of professional traders are still heavily hedged or actively shorting the asset. They're stubbornly positioned for a drop while the market keeps climbing, which is quite literally the perfect recipe for a violent short squeeze. So here's our roadmap for this explainer. 1. The ultimate short squeeze. 2. Moating with real-world assets. 3. The stablecoin floor. 4. Enterprise privacy versus ethos. 5. The looming quantum threat. And 6. Preparing for retail FOMO. Section 1. The ultimate short squeeze. Forcing the unwind. Let's break down exactly why the market is a total powder keg, primed to squeeze those short sellers. When you have high spot prices pressing up against a massive wall of open short positions, all while those funding rates lag behind, the tension is just incredible. If Bitcoin keeps pushing even slightly higher, those deeply entrenched short sellers are going to be forced to buy back their positions just to cover their losses. And that cascading wave of forced buying, that is exactly what could rocket us straight toward that $85,000 mark. Section 2. Moating with real-world assets. The new foundation. So what's actually keeping the price up against all those bearish bets right now? Well, it's a massive rotation of capital into real-world assets, or RWAs, creating this protective layer we call moating. Think of it literally like a medieval castle using a moat for defense. The crypto ecosystem is essentially fortifying the current rally by tethering itself to traditional, high-value equities. By linking digital liquidity directly to the performance of some of the world's most valuable companies, the market is dampening that purely speculative volatility and creating a much sturdier foundation. I mean, just think about the assets that are trading on-chain right now. The BTCC Exchange just launched SpaceX Pre-IPO perpetual futures. That means retail and institutional traders can actually get speculative exposure to Elon Musk's aerospace giant before its official public debut. We're also seeing the on-chain stock market expand, with the debut of Oracle tokenized stock, joining the likes of Tesla and MicroStrategy. We are rapidly blurring the lines between traditional venture capital and liquid crypto markets, offering 24/7 price discovery on major household names. It's a real game changer. Section 3. The stablecoin floor. Unstoppable yield. Now, this moating strategy requires a rock-solid floor to stand on, which brings us to an entirely new base of market liquidity. As the CTO of Sol Strategies flat out stated in a market-wide memo today, buying, holding, and staking just isn't enough anymore. Digital asset treasuries, or DATs, have to actively manage capital to survive what is becoming an increasingly derivatives-heavy market where sudden liquidations happen all the time. Passive management is out. Treasuries are being forced to hunt for active, sustainable yield. And that aggressive demand for yield-bearing tokens has officially pushed the stablecoin market past an absolutely incredible $320 billion milestone today. This isn't just money sitting around idle on exchanges waiting to do something. This is a massive, highly dynamic floor of liquidity that is fundamentally underwriting the entire digital economy. There's a fascinating contrast playing out here. Over in Washington, the U.S. Senate remains completely deadlocked on the Clarity Act. Legislation is effectively paralyzed. But out in the free market, we're seeing this surging, unstoppable demand for yield-bearing stablecoins. The reality is pretty simple. Investors and institutions are absolutely not waiting around for legislative permission to seek out on-chain returns. They're just pushing forward. Section 4. Enterprise privacy versus ethos. The centralization debate. Bringing Wall Street on-chain is definitely not simple, though. As this institutional infrastructure scales, it's creating some deep ideological friction. Take today, for example. a platform called Tempo launched a new feature called Zones. This was custom designed to give major enterprises exactly what they need to adopt digital assets, which is private, permissioned stablecoin transactions right on a public Layer 1 blockchain. It's a direct response to the strict privacy requirements of massive corporations. But oh boy, has this sparked a fierce debate. It's a fundamental clash of values. Institutions and enterprises absolutely require controlled compliance, like this operator-controlled design, just to operate safely and legally. On the flip side, critics are loudly arguing that this centralized structure fundamentally destroys crypto's core founding premise of censorship resistance. It's this incredibly delicate balancing act between attracting mainstream enterprise money and totally abandoning the original cypherpunk ethos. Section 5. The Looming Quantum Threat. Q-Day. Let's step away from the philosophical debates for a second, because there is a literal existential threat to the network's cryptography that we have to talk about. The urgency around quantum computing is escalating so fast. Last year, we saw Charles Hoskinson and Presidio Bitcoin issue severe warnings about the Q-Day threat. Fast forward to right now, May 2026, and the Venom Foundation has just completed a massive post-quantum assessment, publicly urging all major blockchains to begin immediate preparations. The really terrifying projection here is that by 2029, quantum computers could be powerful enough to completely compromise the digital signatures that keep cryptocurrencies secure.
And the fix for this? It's not going to be simple. As Charles Hoskinson pointed out, the solution isn't just mathematical, it's highly political. It's going to require a wildly controversial hard fork, which is a permanent backward incompatible software upgrade, just to protect older, vulnerable holdings. We are talking about rescuing roughly 1.7 million pre-2013 Satoshi-era Bitcoin. These are coins mined by the network's very first users. The true test is going to be whether a decentralized network can actually reach consensus to rewrite its foundational code like that.
Section 6. Preparing for Retail FOMO. The bottom line. All right, let's pull all of these complex undercurrents together. Between the looming short squeezes, the expanding institutional moats, and that massive stablecoin liquidity, this is the number you need to take away from today's explainer, $78,500. With all the macro noise fading to the background, this specific price point is currently acting as the true market mean support level. It's literally the crucial line in the sand for the current rally. If Bitcoin can maintain this moat and hold that support level, backed by those real-world assets and that totally expanding, yield-hungry stablecoin floor we talked about, the entire psychology of the market is going to flip. The extreme macroeconomic fear we saw earlier this month, which had the fear and greed index sitting way down at just 21 out of 100, is likely going to completely vanish.
So I'm going to leave you with this final thought as we wrap up today. What happens when institutional moats cause all that extreme fear to just evaporate? If the fear's gone, the macro uncertainty fades, and those heavily hedged short sellers are suddenly forced to buy back in at way higher prices, are we about to witness the ultimate late-cycle retail FOMO wave? That is the million-dollar question for the market right now. Thanks for joining me to break this all down and keep a very close eye on those charts.